in the futures. Contract can be traded. After the date, the contract must be settled under the terms of agreements. Lastly is the price of the contract is determined by the open market, which reflecting the value of the asset involved. A futures contract, however, will contain a specific price, usually tied to the spot or cash price of the underlying commodities. The contract also will make clear what currency is being used in the contract, such as whatever the asset is priced in MRR or other denominations such as USD or others like Euro, Dollar. Okay, now we will move to the concept of futures contracts. So such as examples, a corn producer want to sell their corn as they're afraid that the price of the corns might drop in the futures. So in order to avoid the losses, they might use futures contract to do it. So by today, the buyer is agreed to buy 5,000 bushels of corn with a price of $4.5, and the delivery date will be set on 15th of December. And the seller agreed to provide it based on their pre-agreement of the contracts. So this is the example how futures contract is how goes like. Okay. So next we will move to the products. What's the products which available in the Phillip Futures? So actually we have 5 types of futures contract, which is first one will be the interest rate futures, such as we offering 2 to 30 years US Treasury notes. And then the second one will be the agricultural futures, such as soybean, crude palm oil, wheat, or corn. And then next we will move to the index futures, such as KLCI index, our Dow Jones, Nasdaq. And then next will be the base metal futures, such as gold, silver, or copper. Lastly will be the energy futures, such as crude oil or gasoline or natural gas. Okay, so in this slide, I will be explain about the settlements. As in the futures contract, we have 2 types of settlement, which is physical settlement and cash settlement futures. So physical delivery is referring to the amount specified of the underlying asset of the contract is delivered by the seller of the contract to the exchange, and by the exchange to the buyer of the contracts. Physical delivery is common with commodities and bonds. In practice, it occurs only on a minority of contracts. Most are cancelled out by purchasing over a covering position, that is, buying a contract to cancel out an earlier sales, which means covering the short, which is the losses, or selling a contract to liquidate in the early purchase. So for physical delivery, normally will be the example of the futures contract with using this type of method will be FCPO, like our crude palm oil futures. Next will be the cash settlement. Is referred to the cash payment is made based on the underlying reference rate, such as the closing value of a stock market index. The parties settle by paying, receiving the losses or gain related to the contract in cash when the contract expires. Cash settled futures are those that are, as a practice matter, could not be settled by delivery of the reference item. For example, it would not be impossible to deliver an index. So a futures contract might also optimize to settle against the index based on trade in the related spot months. So the example is like FKLI index are using this type of method of settlements. Okay. Next is so for your information, the futures market is regulated by the Security Commission Malaysia and Bursa Malaysia Derivative. So for this slide, I will be explaining about what is clearinghouse. So a clearinghouse is an agency associated with an exchange which settles trade and regulate deliveries. So the clearinghouse guarantees the fulfillment of futures contract obligation by all parties involved. The clearinghouse will validate and finalize the transactions, ensuring that both the buyer and the seller honor their contractual obligations. The responsibility of clearinghouse will be include clearing or finalize the trades, settle the trading account, collect the margin payments, regulate the delivery, reporting the trading data, and just for your information, our Phillip Futures also one of the clearing house in futures markets. So, okay, based on the diagram, if obligation without a clearing house, the agreement will be only the buyer between the seller. Hence, this will be occur a counterparty risk. But its obligations with a clearing house, the clearing house will be enter the picture after the buyer and the seller execute a trade. The rules is to compromise the step that finalize and then therefore validate the transactions. In acting as the middleman, the clearing house provides the securities and efficiency that is integral to stabilize in the financial markets. So in order to act efficiently, the clearinghouse take opposite positions of its trades, which greatly can reduce the cost and the risks. And then the facts that they have to act as a both buyer and seller at the inception of the trade means that they are subject to default the risk of both parties. So for information, actually the clearinghouse is very important because they're able to reduce the risk and then they also impose the margin requirements. Okay, so next we will move to what is counterparty risk. The counterparty risk is the likelihood or probability that out of the transactions between the two parties, one parties might not fulfill its part of deal and may default on the contractual obligations. Okay, next is what is the direct market access? Direct market access refers to the access to the electronic facilities and order book of financial market exchange that facilitate daily security transactions. Direct market access requires a sophisticated technology infrastructures and is often owned by a sell-side firms, rather than relying on the market-making firms and broker-dealers to execute the trade. Some of the buy-sell firms use direct market access to place trades themselves. So what's so good in using DMA system to place the orders? So actually the benefit will be the traders will have full transparency of the exchange order books and all its order trades. The direct market access platform can be integrated with the sophisticated trading strategy that can streamline the trading process for greater efficiency and cost saving. Besides, the direct market access also allow the buy-sell firm to open the execute trade with the lower cost. So besides that, it also latency reduction, which is referred to the order execution, is extremely fast, so that the traders are better to take the advantage of very strong live trading opportunities. Means that you can directly enter into the markets without waiting for a long time. While the price improvement involve the achieving a trade at a better price that the price quote at the time and order place, which means that actually you can use the order types to place the order so that you can get the price that you wish for. Okay, so next, what is the advantage to trade in the futures markets? First, the futures market is a high leverage investment, as leverage means that the traders need to commit a little money to control a lot of products. Since a futures contract is based on a deferral delivery, so there is no money is exchanges at the time a trader buy or sell the futures contracts. Therefore, not a lot of money is needed to buy or sell futures contracts. So what you need to pay is you need to pay for the margins, which is the deposits when you want to buy or sell contracts, which represent a performance bond, which is guaranteed that they can handle the risk of the futures contracts. Second is the high liquidity. So market liquidity is important in futures markets because it can impact how quickly you can open and close your positions. So a liquid market is generally associated with less risk, as there is usually always someone willing to take the other side of a given positions. This can attract speculators and investors to the market, which add to the favorable market conditions. So high liquidity, which means that there is a lot of large number of orders to buy and sell in the underlying markets. This can increase the probability that the highest price any buyer is prepared to pay and the lowest price any seller is happy to accept, which move closer together. So in other words, that the bid and the offer spread will be tightened. Next will be the cost effective. So in order for you to trade with our Phillip Futures, we only charge for the exchange and clearing fees, which is referred to the margin of the futures contracts, the brokerage commissions, and other trading platforms. So for your information, our main platform, which is our Phillip Nova, actually is free of charge. Okay, the next one will be the flexibility and the diversities. So in futures market, you can trade in the bearish or bullish trends. Moreover, the Phillip Futures also offers variety types of futures contracts, as every product is unique and different. So it's based on see which products that you're more familiar and you more like. And then actually I've offered a lot of products. See which one are you more likely. Okay. Lastly will be the efficient and fair. So actually it's difficult to trade inside information in the futures markets. So give you examples that who can predict for certain the next Federal Reserve policy actions. So futures market tend to trade market aggregate that do not lend themselves to the insider tradings. So as a result, the futures market can be more efficient and give average investor a favorable shakes. Other than that, short selling is easier in futures market as it is completely legal and applies to all kinds of futures contracts. Okay, this slide I will be explain about the market participants, as there is three types of individuals to participate in the derivative markets, which is hedgers, speculators, and arbitrage. So first, the futures contract for commodities or financial products are because they are the people who conduct an active business in the commodities. So hedgers are referring to the risk averse in the stock market or futures. They target derivative market to secure their investment portfolio against the market risk and the price movement. So give you an example. There's a corn futures contract because they are corn producer which sell corn and the company that buy corn. So the hedger plan to buy or sell a commodity such as the corn, and the buy sell a futures contract to lock in the price, and the main function is to protect against the rising or falling in the price. So they need to manage the risk so that the futures can help to meet the whole truth of all markets, including the financial markets. So internationally, the company will hedge their foreign exchange and interest rate exposure. So similarly, the portfolio manager also will hedge their stock refund. So normally the hedger will be referring to the producer, wholesaler, and retailer or manufacturer. Okay, next is the speculators. So the speculators are the people who analyze and forecast the futures market movement, the trading contracts with the hope of making a profit. So speculators put their money at the risk and must be prepared to accept outright losses in the futures markets. So how do speculator profits? So how speculator earn a profits when they offset futures contract to their benefits. So to do this, a speculator will buy a contracts and then sell back them at the highest price than which they purchase them. So conversely, they sell the contract and buy them back at the lowest price than they sold them. In either case, if successful, a profit is made. So in other words, speculator can be referred to the traders, and speculators are important in the futures market because they're able to bring the liquidity to the market and then assume the market risk. Next will be the arbitrage. Arbitrage are the risk-free arbitrage technique which return a profit without any directional risk. This means that if the arbitrage technique is applied properly, you will make a profit no matter which way the underlying asset move. Arbitrage has existed for a long as the capital market has, and the futures arbitrage is the way of taking advantage of the pricing difference between the underlying assets and the price of their futures contracts. So in fact that every derivative instruments created on the same underlying assets get slightly mispricings. So from the time to time, an arbitrage have the sophisticated program to detect and then take the advantage of such a minor difference in price. Okay, next is long or short strategies. So in futures market, you can long or short the position. So as an example, if you assume that today market might be moved uptrends, hence you can go for long position, which is buy low and sell high. But in another way, if you assume that today the market might be moved in downtrends, hence you can go for short positions, which is sell high and buy low. So another important things for you to trade in futures market, you need to know about what is technical analysis. So technical analysis is the trading discipline employed to evaluate the investment and identify the trading opportunity by analyzing the statistic trend gathered for the trading activities, such as the price movement and the volume, and then also with the past market data. So it's unlikely like the fundamental analysis, which just attempt to evaluate the securities value based on the maybe the business result, such as the sales and the earnings. So technical analysis will be focusing on the study of the price and the movement. Same goes to the volume. Technical analysis tools are uh, used to see the way supply and demand for security, which will affect the changes in price, volume, and imply the volatility. So how do we use for the technical analysis? Actually, it's often used to generate the short-term trading signals from various trading tools, but also can also help improve the evaluation such of the security strength or weakness, relativity to the broader markets or one of its sectors. So this information can help the analysis to improve their overall valuation and estimate how the market will move next. So there's the three general assumptions from TAs. So first one will be the market discounted everything, which is the major technical analysis, which is only considered on the price movement, which ignoring the fundamental factors of the companies. However, technical analysis assume that at a given time, a stock price will be reflect everything that has or could affect the companies, so including the fundamental factors. So TA believe that the company fundamentals, along with the broader economic factors and the market psychologies, are prices into the stocks, which removing the needs or actually consider these factors separately. This only leaves the analysis of the price movement, which technical theory view as the product of the supply and the demand for a particular stock in the markets. Next will be the price move in the trends. So in technical analysis, the price movement are believed to follow in the trends. This means that after a trend has been established, the futures price movement is likely to be in the same directions as the trend than to be against it. So most technical trading strategies are based on these consumptions. Last will be the history will be tends to repeat itself. So another importance to know that is mainly will be on the price movement. So the nature of the price movement is attributed to the market psychologists. So in other words, the market participants tend to provide a consistent reactions to similar market stimulus over the times. So they were using the chart pattern to analyze the market movement and then understand the trends. Although there's many charts have been used more than 100 years, but they are still believed that relevant because they believe that these chart patterns might be repeat themselves in futures. So, okay, for this slide, I will move to the BND product specification. So first, I will be start with the FTSE Bursa Malaysia KLCI futures, which is FKLI contract specifications. The contract size of FKLI is multiple by RM50, where for the minimum 5 price fluctuations is 0.5 index point, value at 25 ringgit, which means that 1 index point is equal to RM50 ringgit. So the contract months available for the FKLI is 4 months. And for this contract, the current spot month will be dropped on March. So next will be the next month, and then the next 2 calendar quarterly months, which is March, June, September, and December. Okay, so for FKLI, we have got 2 trading hours, which is the first trading session will be on 8:45 a.m. to 12:45 p.m. While for the second trading session will be from 2:30 p.m. to 5:15 p.m. So for the final trading day for the FKLI is last business day of the contract months. So I will give you examples. So if the last day, which is 31, is dropped on the Saturday, So the last business day will be on the previous day, which is the 30, so on the 30, which is Fridays. So lastly, the final settlement for FKLI will be cash settlement based on the final settlement values. Okay, so this is the examples of a list of 30 component stock which listed in the FKLI index letters by 1st of January 2020. So, okay, as we can see from the tables, actually we have 12 types of super sectors which include in the FKLI index, where the top 3 largest weightage will be the bank sectors, health sectors, and food and beverage sectors. However, this is quite important as if there is any affected of these 3 biggest weightage, it also will directly affect the performance of the FKLI index. Next, I will explain about which factors will affect the FKLI tradings. So first one will be the crude oil. Okay, the oil revenue is the largest contributor to the government coffers. So strong crude oil price will mean that fuller coffers for the governments, which would have more to spend while being able to retain in its financial in its fiscal deficits. The opposite would be happen if the oil price is fall. The price movement of 2 types of oil, which is crude oil and crude palm oil, which have a significant impact on the local markets, given that the oil and gas and the plantation are 2 major sectors on our local countries. When they are out of favor, so the Bursa Malaysia will be less appealing to the investors, especially for the foreign investors. Second will be the fiscal health, as the weak crude oil price has raised the concerns over the government fiscal health and its ability to spend more to stimulate the domestic economies. Furthermore, the good and service tax, which is our GST, has been launched, but it's already requested by the SST. But it doesn't mean that this one will be the best substitute in the terms of being able or replenish the government coffers. The high national debt than the current administrations from the previous government also have capped the government spending powers. So when the economic outlook look like not so good, it does not argue well for the corporate earning prospects, hence the investment are shying away. Next will be the political uncertainty. This is also one of the main factors which will keep the investors on the sidelines on the local stock markets, as is the uncertainty over the planned handover of power between the 2 prime ministers. So speculation on the transaction aside, investors will be prefer to wait for the dust to settle on the political front, and for there will be certain policies before investing in the countries. Next will be the low interest rates. So it has declared that interest rates stay consistently low, which in return was a boom for the economic growth and the equity markets. This could be seen from the US Federal Reserve low rates and the records-breaking performance on the Wall Street. In other words, money always seeking for the better yields. The low interest rate also will bring down the borrowing costs, which are blessing for corporate world and the consumers. So the business communities could borrow at the low rates for their business expansions, which help to sustain the earning growth, while the consumer also can spend more as the loans will be cheaper. So actually, low interest rates not compulsory back to the governments and the peoples, because you can get a lower interest rates so that you can expand the business. Last will be the trade wars, which refer to the US and China's trade wars, which also will bring the impacts to the performance of the FKLI index. Okay, so for this slide, we will do a simple calculations. If today we long position in FKLI index, how was our profit will be counted? So I will give you examples. So for the current price for FKLI is 1526, and you assume that today market will go uptrends. So you enter long positions, while the value is 0.5 index point at RM25, which means that 1 index point will be equal to 50 ringgit. So if end of the day, the price increased to 1536, which is 10 points, hence 500 will be your profit. Now we will move to the losses part. So we are using the same price with the same positions. So if by today the market is against you, well, end of the day, the price become 1516, which is losses 10 points. So what RM500 will be your losses. So how about we go to the short positions. Okay, so the current price for FKLI is 1526, and you assume that market will go downtrend, so you enter the short position. Well, the value is 0.5 index point at 25 ringgit, which means one index point equals to RM50. If end of the day the price is decreased to 1516, which is 10 points, 10500 will be your profits. Now we will move to the losses part. We also using the same price in the same positions. So by today, if the market is against you, which is go uptrends, and then by end of the day, the price increasing to 1536, hence you also lose 10 points, so 500 will be your losses. Okay, so for this slide, I will do an introduction of Malaysia crude palm oil futures, which is FCPO contract specifications. So the contract size of FCPO is 25 metric tons, while for the minimum price fluctuation is RM1 per metric tons. The contract month available for FCPO is spot months, as FCPO currently spot month is dropped on June. The next 11 succeeding month, and then after alternative month will be up to 26 months ahead, which that you can trade FCPO until the years 2023, because it will up to 3 years. So for FCPO, they have two trading hours, which is the first trading session is 10:30 a.m. to 12:30 p.m. and the second trading session is from 2:30 p.m. to 6 p.m. While the final trading days for FCPO will be at noon on the 15th of the delivery month. And if 15 is non-market day, then will be preceding business day. Lastly, the final settlement for FCPO will be on physical deliveries based on the final settlement values. Okay. Next, what is the fundamental factors that will affect the FCPO tradings? So first will be the weather seasons. So the plantations of palm oil trees follow their specific seasons and the periods. The whole process from plantations to harvest will be take up to 4 years, and the lifespan of the tree can be up to 25 years. The palm oil tree require warm weather with high humidity environment to grow up healthily, as too much rainfall could flood the plantations and hamper the harvesting, and dry spell would affect the plant's growth. Then thus it also will lowering the productions. So I'll give you examples. El Nino effects influenced Malaysia palm oil yield in 2021. The productions dropped to 3.12 tons, which is the lowest of this year. Actually, the average will be on 3.7 and above. Hence, the season also can affect the yields of palm oil, which the lower the production translated to a higher than the palm oil price in the market. So second will be the festival season, as it can increase the demand for the oil. For example, Chinese buy for the Lunar Year's holidays, while Indians buy for Diwali, while Pakistan, Bangladesh, and Middle East country will buy for their Eid festivals. So people use it for a religious praying purpose. So with the high demand of oil use, the price will be increasing too. Third will be our biggest competitors, which is Indonesia. The production of palm oil in Malaysia and Indonesia has taken up around 90% of the supply to the world. So Malaysia is currently the second largest palm oil exporter in the world, who is surpassing by Indonesia in 2006. Indonesia expects to double their production by the end of 2030. While Indonesia keep increasing the output, it can cause the price decrease, and the profit margin of Malaysia can be affected. Or there might be in another situation is if the Indonesia can supply most of the demanded in the market with better tariff rate, our Malaysia also will love our competitors' ability, or we will be being forced to sell at a lower price. Okay, so the fourth one will be the competitors from other eligible oil, such as the price of palm oil can be affected of by other vegetables oils like sunflower oil, rapeseed oil, corn oil, and especially our soybean oil. When the bad weather fall on the soybean plantations, it can help in increasing the palm oil price. Like the US, Brazil, and Argentina are soybean producer countries. Once their oil supply is below the market needs, so the palm oil will be the substitutions. Last will be the tariff and the policy. So Malaysia are relies on exporting to build out the country economy. Hence, to hit the GDP highest, the government may lower down the tax rate to help in strengthening the export and reduce the inventories levels. This exchange action can make the liquidity if the market is higher, which is more favorable to the traders. Okay, so now I will explain about our margins, as we have two types of margins. First one is the initial margins. So the initial margin is the minimum amount of cash that must reside in the trader's trading account. So the first day when the trader is established a futures positions, whether long or shorts. So uh and the range will be around 2 to 20% of the market value of the futures positions, although it can be lesser. Next will be the maintenance margins. So the maintenance margin is the minimum amount of cash that must reside in the trading account on the second day and every subsequent day, as long as the traders will continue to carry their futures positions. So the maintenance margin is usually less than the initial margins. So the amount of cash one need to carry a position is less than the required to establish a positions. So the margin requirements are met by the cash or equities in the trader account, and the equity is being lesser if the trader futures position started to lose money. However, the equity also will be increasing if your positions become profitable. So if the total equity in the trader's account falls below the maintenance margin level, then he will be required to close the positions or to deposit the additional fund in his trading account to bring back the equity level up to the initial margin levels. This request for additional funds is referred as a margin call. The determination of the account equity is done by the clearinghouse. So at the end of every trading day using future settlement price. Okay. Okay. So next will be the example of margin call. So let's give you examples. If by today you enter one FKLI January 21 contracts with the price of 1550 and the initial margin for FKLI contract is 4002. So if end of the day you still holding these positions to overnight, so the market will be closed at 1540, which you already lose 10 points. So one index price is equal to 50 ringgits. So the total losses will be 500. Hence your account equity will be left 3,700. So 500 will be your margin call amount to be answered on next day. Okay, next I will be explain about the market orders, means order types. We have a few types of order types. First one is the market order. So a market order is an order to execute at the best possible price available in the current market. This type of order guarantees that the order will be executed but does not guarantee the execution price. A market order generally will execute at or near at the current bid for a sell order or ask for a buy order price. However, it's important for investors to remember that the last traded price is not necessarily that the price at which market order will be executed. While for the limit orders, it's an order to buy or sell a security at the specific price or battles. So a buy limit order can be only executed at the limit price or lower, while for the sell limit order can be executed at the limit price or higher. So I'll give you examples. If an investor want to purchase shares of ABC stock for no more than $10, so the investor could submit a limit order for this amount, and the orders will be only be executed if the price of ABC stock is lower than $10. Next will be the stop orders. Stop order is an order to buy or sell a stock at the market price. Once the stock has traded at or through at a specific price, which is the stop price. If the stock reach at the stop price, the order will become market orders and is filled at the next available market price. If the stocks fails to reach at the stop price, the order are not be executed. So in stop order, there are two types of order, which is buy stop order or sell stop order. So the main function of stop order is to minimize the losses over your positions. It also can protect your profit of existing positions and also to initiate the new or short positions. So last, what is the difference between the futures and stocks? So at the basic of equity, including that when you invest in a companies, right, actually you are buying a piece of shares as you are holding these shares outright or through the mutual fund. But with futures, you are not investing in the corporate and the entity. Instead of you are buying a contract to have exposures to the physical assets, ranging from the corn or soybeans to coffee or oil. You may also buy the futures contract to cover the stocks, bond, currency, even with the even with the weather stuff. So in stocks, you may not, you are actually holding the shares certificate in your hand. So at least that you can see the security represented in your online account. Okay, so besides that, if you trade in the stock market, as you are holding a shares of a corporation, so you are entitled for the dividends. So however, in the futures market, you are not entitled for the dividends, but you have the ability to do the short selling in futures markets. So in futures market, you only have to pay for the margin amount which required by each contracts. And this is quite different with the stock market because you need to pay for the true values. So lastly, how to kickstart your trading in futures market. So you can open an account with us, and then you also need to know which level is your risk appetite. Besides, you also need to study that the product which are you interested. You also need to understand about the product fundamental analysis and technical analysis. After you understand all this, and then you can start your trading. But make sure you need to update keep yourself up to date with the market flow, and you also need to keep learning. So happy trading, everyone. Okay, that's all for my presentation. So if you have any question, you may drop in the box, and then I will explain it later. Thank you.
Okay, so thank you very much for Shireen's presentation. So actually, Shireen's already covered about future, what is futures market and how it works. Okay, yeah. So like what you mentioned just now by Shireen, any questions from the floor? You may type in your questions on the questions box. Okay, so I'll read it out for Shireen to answer. Okay, yeah, Shireen, we got a questions for you now. Hello, Shireen, are you ready?
Yes.
All right. Okay. So a question from Mr. Muhammad Ramzan. Okay. So the question is, if we going to long, so how to close these long positions? Okay. So secondly, if we go for long or short, so how to place a stop loss?
Okay, so when you go for the long positions, how to close the position, is it?
Yep. Mm.
Okay, actually we have two types. If by today you are monitoring your positions, you may directly close your order by placing the market order. But if today you are quite busy, right, you can you can place a sell stop limits and sell limit. Then when the price is hit the price that you wish for, and then it will be auto close your positions. Okay, so next question is
How to
can you
place stop loss?
or you mean stop loss?
Yep. How to place? Yep. Stop loss.
Okay, so for if you're using our platform, actually we have the stop orders. So actually you can use the stop orders, and then you just need to key in the price that you wish for, and then when the market goes against you, and then you hit the price, and then it also will auto close your positions if you place stop orders in your your trading account.
Okay, thanks for your answer, Shireen. Okay, another question on the floor is, okay, I think Mr. Key is asked about, is it possible to learn trading for FCPO or FKLI on a part-time basis? If let's say I'm working full-time, so I guess Mr. Key is working full-time, so he got the initiative or interest to learn about FCPO or FKLI. So is it okay to study it on a part-time basis?
Yeah, sure. Actually, for FKLI and FCPO, right, if you are not so sure, maybe you can refer back to our previous webinars. We also can blast it to you. Well, besides that, you also can learn from YouTube and then see the market news regarding to the what is the market currently. Like currently, FCPO is very volatile as the quite several reasons lah. So actually, it's not hard for you to learn on a part-time basis. Uh, but you can refer to the market news by YouTube, and then you also can learn on the TA how to see the how to estimate the price movement and what is the trend. Okay. Mm.
Mm. Yeah, so like what I also mentioned during my presentations on the introduction part, so you can access to all the social media that we have. So we will post some of the market news and also for FCPO FQI. Yeah. So for sure you're able to like maybe after your working time, right? You can go to our website or you can go to our Facebook or maybe you can go to our email, right? Then you can have a look on so today's commentary is about FQI also FCPO. Yeah. Okay, so another question for you, Shereen. Which one is more riskier, futures or stocks? So in terms of the volatility.
Okay, actually, based on the volatility, actually stock will be more risky compared with the futures. Futures, yes, because as you can see, the price in the stock market, right? Maybe we already do a simple calculation on the data. We compare with the stock and the futures, and then we found that actually the stock is more risky compared with the futures. Okay.
Okay, yeah. So new questions for you, Shereen. So with so many algorithm trading in the markets, so is it still possible to trade profitability?
If in futures market, yes, you could. Okay,
Okay.
how to trade more profitability means that actually you need to more study more on the product that you wish to enter in for. Like I give you an example, like you have interest to in FCPO. So actually you can study back on the past market data, see the trading volume and then see the TA and then just join together with the fundamental analysis like market news and then you can just mix it up and then I think you can if you're able to predict the correct trends, right? So actually you can make a profit from here.
Right, thanks for sharing. So in short, meaning to say that we're still able to study our own self by using TA and also FA without any algo trading. Yeah, right. Okay, so far no questions on the floor. Is it any questions from the floor? Yeah. Okay, we have okay, Mr. Chi, I think. Yes. Oh, no problem, Mr. Chi. We will pass your contact details to the KD branch, okay, to follow up with you. Okay, you'd like to know more about this and also open account, right? No problem. Okay, I will take note for this. So if let's say anyone who want to open an account or want to have a one-to-one coaching sessions, yeah, just feel free to type in the questions or chat box to let me know so I can take note on this. Yeah, I will ask the related branches to contact you, okay, to arrange about maybe the appointments, okay. Yeah, so feel free to subscribe our social media channel, okay, to know more about market and stay close with the markets. Yeah, maybe. Okay, okay, yeah. Okay, yeah, questions from Nila. So, Nila actually asked about how are futures beneficial than warrants for day traders? Maybe Shereen can answer about this. Yeah, this is the last question for today. Yeah, I guess so. Hello, Shereen, are you there? Yes, the webinar is recorded. Mr. Kang, is it? Okay, I'm not sure. Is this Shereen? There maybe speaker elect. Okay. Yeah, so for futures and warrant, right? So futures and warrant is different thing, for sure. Okay. So you need to for me, the answer for me is both of these financial tools or financial activities for futures and warrant able to benefit for all the traders. So you need to base on your own self risk appetite. Okay. For me, I will think that warrant is more more riskier or more volatile lah, compared with futures. So also depends on what the mother share is for this warrant is. Okay. So for futures, right? Because futures, we need to like study the macroeconomics. Okay, like gold. We need to study about gold, right? We also need to study about currently market, which factor able to, will affect about the gold market. Okay, so currently we will not only study about like gold. So if let's say warrant, right, we study about the mother company, right? Okay, we only need to know about how the company like to performs. Okay, something like this lah. Okay, so also it's quite vital that is based on what your risk appetite is. Yeah, to trade on different type of the financial products. Okay, yeah, so we'll call it a day. Thank you very much. Thanks for the times, and also thanks for all the attendees and also our speaker for today, Shireen. Okay, so any questions from you guys after this, you can email to us or call into our nearest branches to answer. We will answer you lah. Okay, yeah. So have a nice day. Bye bye.